Uh,
No. Okay, we're live. Anyway, Colin, welcome to Venture with Grace today.
yeah, thanks so much for having me.
Want to start off with like your Chinese skill? Or maybe we start talking in Chinese. But anyway, you have such an interesting background. So I've like binged like all your podcasts and like, so basically you when you were in college or like not college, like when you were so you at your first job you were traveling, and then during this time, basically they mentioned like people are gonna start laying off people. And I think that this is like your Verizon era. So like basically they're starting laying off people, and then you started working on your own projects. And you first started like the um DoorDash, but back in 2003 or something. And later on, I'm sorry, I think that's the Lexmark era. I don't know. I'm
Oh
butchering all the
yeah,
timeline.
no, it's
So why don't we start with you telling the audience about like how you started the back in time like food delivering app era things.
yeah. I mean, I wouldn't. I would argue I didn't start it per se. Like it's weird. I got this title as like the grandfather of online delivery, um, mostly because I wrote a lot of the like underlying technology patents, right? Like I think the concept of food delivery had been around for a while. The thing that I ended up doing that was novel was at that point in sort of 2006 2007 people were still sending orders to restaurants via like fax machine.
Mhm.
And what happens is like when the restaurants get busy, which is like very common during like dinner time and like sort of
Mhm.
exactly what you expect, everybody kind of eats at the same time,
Mhm.
the fax lines would get really busy and the fax machines wouldn't receive all the orders. And so as they tried to scale this industry, you hit this bottleneck that was um, your ability to get orders through to restaurants. So the first patent I ever wrote, which was my senior year of college, was around like directly integrating those orders bidirectionally into the point of sale system so that you could see how much inventory was there, how many orders were in like the queue waiting in front of you. And you could put your order into that queue as well and see when like things were out of inventory and all that. And so that was like this critical piece of technology. Originally we built it for stadiums and arenas because like we ran into this problem way before traditional online ordering in restaurants, because in stadiums you had like 20,000 people trying to order a hot dog all at the same
Mhm.
time. And so we had to deal with those problems from the very beginning. So we kind of stumbled into it, right? Like I was in many ways just trying to solve a problem that was like a bit of an annoyance for me. And I think this is how most like founder journeys start, right? Like there's something you see about the world and your obsessive compulsion like kicks in and you say to yourself,
Mhm.
I have to fix this. This has to be fixed and it has to be me. And that's sort of how the whole journey started.
I wonder, so I have so many questions there. Like number one is like I know that like, back in time startup was like not a popular thing to do. Plus like, back in time I feel like the people can code are like completely like not in the mainstream. But like now I feel like a lot of younger kids, they're like growing up destined to like, create a tech startup or something. I wonder how did you kind of like decided, entrepreneurship is your thing. And it sounds like your dad worked at like IBM. I don't know what your mom did, but like I feel like it sounds like they're both like in the more traditional like career path route. And I wonder what's your like, I guess like how do you kind of like motivated to do a startup? And then is there any opportunity in like today's world that's kind of equivalent to doing a startup back in like 2006?
Yeah. So in my case, like entrepreneurship was kind of always in the cards. Um, my grandparents on both sides were entrepreneurs. My grandfather on my mom's side had a chain of barbershops.
Mhm.
My grandfather on my father's side had a sparring business. He actually was a sparring partner for Joe Louis and a number of other like boxers, sort of in the 60s and 70s. My father was an engineer at IBM. My mom was an engineer at Procter and Gamble. In 1993, my father left IBM to start his own company called Bith Group Technologies, and he basically was doing very similar things to what he was doing at IBM, but doing it for himself.
Mm.
And I think one of the things I've seen over the years is there's a couple of different flavors of entrepreneur. There's like the person who's being a founder and probably shouldn't be, like they probably want a little more safety, a little bit more control, over the outcomes that they see. There's sort of founders who are this happy mix, right? Where it's like they're just as happy being in a team at Google or Meta as they are building their own thing. And then there's this third category, which is like people who are unemployable, right? And like I was probably in the third category at that time, which was like I just didn't want to be told what to do. I had a very clear sense of how I thought the world should be and how I thought things should be done. And if what you were telling me was inconsistent with that, it didn't really matter to me that you were my boss or that you had been there longer or anything along those lines. So I think that was one of the clear like realizations very early on in my career. And in my case, when I was in college, I was co-oping. And so for people who don't know what co-ops are, every other quarter, I would work for a company. And so I worked for Verizon, designing like telecom networks. And actually, I was overseeing a project to remove payphones from Baltimore and like the DC area. This is how like long ago this was. I ended up working for Georgia Power, designing substations like for power transformation, and sort of stepping down and stepping up power before it goes across the transmission lines. And so you have lots of these like experiences where you get a sense of like what works well for you and what doesn't. I think it's easier now for founders to start something. You have Y Combinator, you've got Techstars, you've got lots of angels who are willing to fund, you've got angel list and so on. This is a good and a bad thing. The good thing is if you've got a good idea and you're really committed, like there's lots of opportunity and capital for you. The bad piece of it is it makes entrepreneurship seem easier and more appealing than it actually is. The reality is it's really hard. Even if you're good at it, it's really, really hard. And it requires a lot of sacrifice and a long time. And I think, there has been a whole genre of founders that have kind of stumbled into entrepreneurship thinking like, oh, this is a quick way to get rich, and have come to this sort of tough realization that like, no, it's a slow way to possibly, hypothetically, if you're really good and you get lucky, get some money after you've paid taxes, right? Like that's the reality compared to maybe how it's been romanticized. So I think it's, again, good and bad. One of the classes I teach, I teach a class at Stanford called Startup Garage. And, the beauty of it is you have a bunch of students from Stanford who come into this and they're like, I want to be a founder. I think this is awesome. And by the time the quarter has ended, 80% of them are like, yeah, I'm probably not an entrepreneur. Like I will be an early employee. I will be a product manager. But I'm not, I don't want to be the person who's out sort of like fighting the fight every day. And that's good because I think you save people a lot of pain and sort of anxiety trying to be something that's maybe not a great fit for them.
I wonder, okay, so I wrote out some questions that's like after hearing background. You have like been in both like YC and Techstar like in the past, and from what I heard, you both time when you apply, you already had revenue. So I've heard from my friends who applied to these accelerator who have done successfully, everybody has some sort of revenue. I don't know if that's like a prerequisite to get in, but like I wonder like what's your thought on like evaluating like companies coming out of accelerators, let's say, like, because I know Techstar is like only 12 people per badge or something, and then for YC it's like hundreds of people.
Yeah.
I wonder if you're like, since you're an investor today, how would you kind of evaluate the best deal coming out of the accelerators?
Yeah. So, I think it's less correlated to how much revenue you have and more associated with have you done everything in your power to de-risk the business prior to coming into the accelerator, right? Like as the name would imply, the whole goal is to accelerate you faster than you would otherwise, right? To get you to move quicker. And if you are encumbered by things that can't be accelerated by an accelerator, then you kind of just end up being dead weight for the whole program. And what are some of those things? These are things like hustle, ingenuity, tenacity. Those are things that like accelerators not going to help you with, right? And so what you find sometimes is a company will come in and they won't have any revenue because they don't feel like selling, or because they're scared to be told no, or because they don't want someone to tell them that their product sucks and that it's like not compelling enough in its current form. And so like I think that's where you see the revenue correlated with sometimes rejection. It's not the dollar amount, because honestly, if you're really successful, like in applying to an accelerator, your revenue numbers are still really tiny, right?
Mhm.
It's like for anyone who would get into any of these programs, they could easily go and rent their brain to McKinsey for $500,000 a year, right? And so like the business is wildly negative from day one when you take, 3 brilliant computer scientists from MIT and have them all work for $50,000 a year on some problem, even if they're generating $5,000 a month or $10,000 a month or $20,000 a month, those are not real numbers compared to the mind sort of capacity or brain capacity that they represent. And so it's again not about the revenue number. It's like, are you doing the things that you need to move your business forward? And are you addressing the problems in your business that are not money problems, that are not accelerator problems, that are hustle problems or effort problems?
I think that's a really great point. And like from listening to your chat with this other person, I feel like I've learned that like I feel like people should be kind of having revenue as in the back of their mind to like really focus on it, like because eventually you're building a business than building a piece of technology or anything that's like things that you want to build. The CEO should be selling. I wonder when you first started the, let's say the point of, not point of sale, but like the, I think it's FanGo. So like when you first started the software, I guess at what point, so you mentioned you registered the patent, and I wonder at what point did you started selling? And I know that you went to meet for this gentleman who were like waking up at 5 a.m. and they who made an introduction for you and the university, I believe like the university football stadium or like basketball stadium. I wonder how did you kind of like make your first sale?
Yeah, so I actually was really fortunate because um, I was going to a bunch of like networking events. I was living in Lexington, Kentucky. I was working for Lexmark, and there was a gentleman named Arthur Green or Artie Green, and he was just like at one of these events and was making the rounds. And it turned out I actually knew his daughter from undergrad. She had been at one of the schools that was near Georgia Tech, and I had met her in passing. And so I ended up moving to Lexington. I was working there and trying to build this like software on the side. And it turns out that Artie was the special assistant to the mayor of Lexington. And I was telling him about what I was doing. And like, this is something that founders do very frequently, right? Like this soft pitch, it's like 5 second. And this is why, like, as an instructor, I hammer my students so much on like, can you articulate what the heck it is that you do in a short period of time? Because it will be the thing that you do most frequently of all the tasks that you have as a founder, is communicate what the hell it is you're doing in a way that is clear and concise and represents value. And so I basically did that to Arthur and said, hey, I got this thing. It's going to let people order food to their seats in stadiums and arenas. I think it could work here in Lexington, maybe for University of Kentucky. I don't know what the next step is. And Art says, this sounds awesome. Let me set you up with the mayor's office. Came into the mayor's office, pitched them. They said, great, talk to Rupp Arena, which is the arena for University of Kentucky, but it's also owned by the state, excuse me, by the city of Lexington. And the next thing I knew, we had our first customer, right? And the nice thing about Rupp Arena was it's one of the largest arenas in the country. It's like 6,000 seats larger than Madison Square Garden. And so by piloting it there and having a lot of success there, it made it much easier to go to anywhere, because if it worked there, it basically would work in any facility. And so, again, I think sometimes founders are very paranoid about their idea and they don't want to talk about it because they're afraid someone's going to steal it. And there's a couple elements of that. Like, one, there's almost 8 billion people in the world. Like, if the thing that you're doing, if you genuinely think that it is uh, uh, unique and no one else in the world is doing what you're
Mhm.
doing, like, you're deluding yourself. It's just statistically impossible that you're thinking of something that no one else in the world is thinking. Now, they may not have your skills, they may not have your access, they may not have capital, they may not have like your pedigree, but the idea itself, I can't tell you the number of times when I was building the Techstars programs here that someone would apply to program and they'd say, "We are the first company to do X. We're the only company that does Y." And they were literally like the seventh one that day that we were reading an application that was like, "We are, generative AI chatbot for customer support. And we're the first one in the world." It's like, no, you're not. You're not even the first one today. So I think this idea that, you're the only one that has idea, you should dispel with that because it's not true. I think if it's easy for someone to replicate what you are doing based on you just telling them 5 sentences on what you are doing, it's probably not a defensible business. You're probably going to have trouble as you continue to scale and sort of prove that there's value there. So I think being willing to share your idea, the sort of concept I keep in my head is these ideas are kind of like a snowflake. It's like the tighter you try to hold on to it, the more you are likely to melt it. And so, like, being willing to share it, I think, is a really important attribute so that people can help you. And in this case, already helped us in a way that was really material to where we were able to take the business.
I wonder when you were thinking about like building a investing, like basically when you were first learning about investing, coming from an entrepreneur background, what were things that you already know, and what were the things that you kind of wanted to intentionally learn?
So a lot of the operational things around like people management, that I didn't know that well. Funny enough, I had been the captain of the lacrosse team at Georgia Tech from my sophomore year until my senior year. And that has some elements of like management to it, right? Like, you have to sort of rally this team and get them to align behind a vision and goal. That part I didn't have any trouble with. I think the day-to-day of like individual personnel management and building the culture, those were challenging when you're like trying to be an individual contributor yourself. So I definitely made a lot of mistakes there as I look back on it. Um, the technology, I thought we were like way out in front of most of what was in the market. We also made that mistake of being very technical and thinking that technology is enough and that was going to save you. Uh, in most cases, it's not the technology that really is the deciding factor. And the reason why is because, in these emerging markets, like these industries where they're not mature yet, in most cases, the customers don't actually know the dimensions that they're buying on. It's like if you were sort of in the era of the first automobiles and someone comes to you and says, "Well, I have a 2 horsepower, vehicle." And the next salesperson comes to you and says, "Well, I have a 4 horsepower." And the customer says, "Well, what's a horsepower?" Right? In that context, it's like you're trying to differentiate on this thing that the customer has no concept of. And so, in our case, we were so indexed on the technology. Oh, we have low latency. We have like SSL security. We can pass orders faster. And the customer is like, "I don't know what any of that means." And so I think in some ways we lean too heavily on that, and it kind of put us behind in a way on the sort of the dimensions that mattered towards progressing. So I wish I had paid more attention to that earlier on in the business.
I wonder when you're, because in each batch of like YC or like everyday in your everyday life right now as an investor, you probably come across a ton of deals. What were some benchmark you are using to filter out, let's say, the 90% deal that are like not meeting the bar? And what are some, I guess, like benchmark that you are leveraging to kind of evaluate the current deals?
Yeah. So there's a concept that like a framework I created, I don't know, 4 years ago, 5 years ago. I teach it a lot at Stanford. And it's this idea of like knowledge arbitrage. And the idea is that like the availability and the value of knowledge, they're inversely proportionate with time. So when you start off doing this thing that is like being a founder, you don't know very much about what you're trying to do, but if you did, it would be really valuable to you. And if you fast forward sort of, 10 or 20 years, you know a ton about online ordering for restaurants, but it kind of doesn't matter anymore because it's already now an incumbent or the whole world knows the same things that you know, right? So the value of it has sort of decreased. And so the game that you're playing is like you're trying to accelerate your creation of knowledge faster than the value that knowledge appreciates, right? Like, can you get smarter faster than that knowledge becomes irrelevant? And that translates to how we look at founders, because the thing you're trying to figure out is how well are they diverging from the benchmark of knowledge in a given space? How well are they creating new knowledge, new understanding, new insights than everybody else? And so when you look at a founder and they sort of give you an update and 30 days later, they're basically in the same place telling you the same things, that's not interesting. Like that to me says like, okay, you're not learning fast enough. Everyone around you is learning quickly. You're still running the same experiments, or you're running experiments that don't matter. And that becomes really difficult to turn into a valuable business over time, right? The whole founder journey is knowledge arbitrage. It's like this thing that you know that is strangers will ride around in other strangers' cars and nobody else knows it. And the longer that you can preserve that, the longer that you can continue to build that lead while everyone else is still under the belief that this won't work, the bigger your company becomes, right? The more value is created for you, for your shareholders, for your employees, for your investors. And so that's like the number one thing that, I would look at to begin with. You've got to look at leadership. Like that's a huge component, right? Because in many cases, the businesses, they'll oscillate between being sort of capital constrained, like financial capital constrained, and being human capital constrained, right? Like initially you start off, you have an idea, you try and go recruit some people, like you go on this journey with you, right? Because you were human capital constrained. Then they join you, you're able to make some progress, but now you're financial capital constrained, right? You need some money to go and build. Someone like myself or another investor writes you a check, and now you're no longer financially constrained, but you're again human capital constrained. What's the first thing you do? You go out and you hire more people to try and build the team. And at some point you're now capital constrained again, right? So like there's this almost sinusoidal curve where you're going between financial constraints and human capital constraint. We can help a ton with financial constraints, and we can help a fair amount with the human capital. You as a founder, though, have to be very diligent about being able to recruit, being able to retain. We can't do that for you as an investor. We can make an introduction. We can suggest that people come work with you, but ultimately you have to sell them on leaving the wonderful opportunity that they have in front of them to come and join you. And so that leadership component, that ability to inspire others, that's critical to building any business with any sort of longevity to it.
I wonder, how do you so for example, if you are seeing, let's say if the founder was able to convince people to join them, but let's say they already recruited a certain amount of people and then they have a certain amount of revenue, I guess how do you benchmark? Like, would you look deeply into the data first, or would you kind of getting a good sense of the founder first? And in terms of the problem they're solving, I guess there's two parts of the question. One is let's say, do you have a thesis towards what you're investing, and then you're trying to find the company that match with the portfolio? Or would you just because for example, if a company come at you, they have a certain amount of revenue, they're growing really fast compared to, let's say, their download in day 1, day 7, day 30, they're all overly performed than their competitors. How would you I guess having a set of benchmark that's concrete to evaluate if a deal fit into my investment thesis, or the numbers set of things versus
Yeah.
the soft qualities?
So our firm might be a little bit different, like at Lobby Capital, than some others, because I don't know if I can see the future, right? Like, and I think there's a level of hubris that sometimes comes from investors that haven't like built or operated or been in the space long enough, where like they think that they know more than the founders do. And our philosophy is like, I can't build the future, or I can't, excuse me, I can't see the future, but I can talk to the people who are building the future, right? They can tell me what they see. And so a lot of it comes down to listening to founders that are building in those spaces and starting to pattern match and understand what are the commonalities. I think what becomes really apparent as a investor is the common modes for failure, although you may not know the modes for success. Right? It's like, I can't tell you if this business is going to work or not work, but I can tell you like that one's probably like that strategy is probably not going to work. You might still not be successful, but this like strategy over here, like doing that's definitely going to be a dead end. And so you end up looking a lot at those examples. Like really common ones are the market's too tiny. Like even if you are successful at building this thing, even if you can hire the team and raise the money, it is not compelling enough, or the market's not large enough for you to be able to create the value you need to make the venture model make sense. I think a lot of times people don't realize like venture is a very expensive form of capital, right? If you just look in the sort of scheme of cost of capital, it's like very expensive. And it makes sense in these environments where, it's a winner take all or winner take most, where you need to go really, really quickly. You really need to have velocity. I use the concept of like rocket fuel. Venture capital is like rocket fuel. It's really expensive, it's highly volatile, and it's amazing if you're trying to go to space, right? Like you're going to go to Mars, you need rocket fuel. If you take rocket fuel and you put it into like an old pickup truck, you're just going to blow the whole thing up. And the same thing happens when you put VC money into a business that's not designed to go quickly. It doesn't want to go quickly. It wants to be comfortable and maybe super reliable and that kind of thing. And so, we saw this a lot in the last cycle, where like a lot of businesses took capital that was VC money and they weren't VC businesses. And what you saw is it kind of destroyed the companies. It made them make decisions as if they were a rocket ship. They tried to fly, but turned out they were a pickup truck, and that's usually a recipe for disaster. And so, I think we try not to, anticipate too much like where founders are going to go, and instead be like quick followers, avid listeners. We ask a lot of questions. We leverage, our lobby conference and ecosystem a lot, which brings in a lot of exceptional people to talk about what they're working on and sort of what they're seeing out, in the marketplace. And I think that's the key to success. Again, rather than trying to like see the future. It's always amazing to me, like how many people are experts in a given vertical after the bull run. It's like all of a sudden everyone's an expert in scooters, and you realize like how kind of short-sighted it is to say like, okay, well, we're a VC fund, we only invest in scooters. It's like, well, that'll be a thing for a couple of years or a couple of months, and then what? So we're very much generalists.
I wonder when you're, let's say if you're like a person who is under investing today, and then they're trying to pick the 3 company out of YC that's going to be successful in this batch, how would you quickly filter out like that, let's say the 95% company that like doesn't matter that year?
Yeah. And I would be remiss to say like the companies that don't matter per se. Like I think the way I would describe it is, as a founder, you're sort of selling 2 products. One is the product, it's your business and product and service and so on that you're selling to customers. The other is this equity in your company that you're selling to investors. And in the same way that not every person you talk to is a customer for your product, every investor you talk to is not a customer for your equity, right? Like they all have different dimensions of evaluating you, different requirements, different needs, and so on.
Mhm.
I would say that in venture, one of the big requirements, like, let me back up some. In venture, there's kind of three numbers that matter, right? It's like, how
Mhm.
much did you pay to get into a company? How much did you get out when the company became liquid? And how long transpired in between? Like, those are
Mhm.
the three numbers that matter. And so
Mhm.
the thing that you're optimizing for is like, can I get, reasonable terms in terms of buying into a business? Is there opportunity for the business to exit or IPO at some point? And how long do I think that's going to take to happen? There were a bunch of businesses that come into accelerators or even outside of accelerators that are great companies, but they're going to take 40 years to build. That
Mhm.
model doesn't really fit with venture, right? Again, going back to the rocket analogies, like they go from being on a launch pad to being in space in under 6 minutes, right? Like
Mhm.
you need to be able to get to velocity very quickly, escape velocity in order to sort of get out of the atmosphere. So there's a bunch of companies where it just may take too long. They'll be successful, they'll generate returns. It will take longer than our portfolios sort of can accommodate.
Mhm.
The second scenario that you see is the TAM is just not big enough. Like the market's just not large enough for you to be able to capture enough. Again, if you think about the venture model, let's say you're investing in maybe 20 companies in a given fund.
Mhm.
Well, 12 of those companies are like pretty likely to not return any capital, right? They just don't
Mhm.
make it for one reason or another. Probably 6 of those companies will return maybe 1 to 1.5 times the capital invested in them. And that kind of covers the operating costs like of a fund and so on.
Mhm.
Roughly 2 of those companies will generate 90% of the returns for a given fund. And so what that means is you've got to have companies that are in your portfolio that basically are capable of paying for themselves, all of their employees, the 18 other companies in that portfolio that didn't generate a return, and all the
Mhm.
expenses associated with all of the sort of lawyers and the IPO and like you
Mhm.
name it. Like that's the level of capital efficiency you need from the companies that you're backing. And a lot of times a company just doesn't have those attributes, right? It turns
Mhm.
out software works really, really well for that, right? Because it has a high fixed cost in terms of generating it, but the variable cost of sort of replicating it is very, very low. It tends to be products like that because they're the only ones that tend to throw off enough cash to support the underlying model. So,
Mhm.
anyways, to your point, there is an archetype of company that tends to be successful. And there's a pretty clear archetype of
Mhm.
of company where they generally don't work for venture.
Mhm.
Um, the other thing we see is like you are successful in creating value in a space where you can't hold on to the value. Like the minute that you
Mhm.
expose that there's something of worth there, everyone can come in and take it from you, right?
Mhm.
So these are examples like you may be selling to a very small set of customers like NASA or and we see this sometimes in like waste management. Like maybe you're selling a solution to waste management companies and there's only 6 or 7 waste management companies and they're all little monopolies inside of each municipality. So you come in and you want to sell them a solution. It's a great idea. You only have one customer. If they decide to tell you no, you don't have any other options. And
Mhm.
so even if you're creating a lot of value there, they're not going to let you keep it. We ran into this at FanGo, right? Where we were selling the stadiums and arenas, and the NBA would say, "Hey, this is awesome. This thing that you're doing, we're going to give you 5% of the value of what you're creating because we're the NBA. Where else are you going to go? And if you don't do it here, then you won't be doing it in basketball, period." And that meant that we weren't able to capture the value that we were creating. So we ended up moving into restaurants, and that became GrubHub and sort of that whole journey. But in many ways, like we were selling to a small set of customers, and that was the challenge for us.
Mm. I wonder, okay, so based on what we just chat about, like, let's say basically you're shooting for each of the company you invest in are likely to return the whole fund if they succeed, right? So
Absolutely,
when
absolutely.
you're thinking about TAM, like what is like a good TAM? So like I feel like most of like the company that I've seen are like in a subsector of this really giant market, and they paint the picture of this giant market is gonna be like dominated by them, and like But it's like, okay, there's like 45 solution that's like in the adjacent area. I wonder, how do you kind of like identify TAM? And you
Yeah,
also mentioned like timing. Like, okay, so I'll save the second question for later.
that's
Oh,
okay.
also, yeah, I want to say hi to the audience. Hi, Shiraf. Anyway, keep going. Sorry.
You're okay. All right. So I want to give you some like inside baseball and TAM thing. My rule of thumb is like usually $2 to $10 billion in that sort of serviceable market, or like even within TAM. The interesting thing about TAM is it's an entirely contrived number, right? Like if you think
Mhm,
about it, it's a function of the assumptions that you're making.
mhm,
So you can start with a TAM that's really, really big and then make a bunch of assumptions that get it to be really tiny. Or you
mhm,
can make a bunch of assumptions that allow it to continue to stay big. And so when I look at a TAM that's somewhere between $2 and $10 billion, there's a couple things that it tells me. One is that if the TAM's over $10 billion, it's usually too big, which means that you're either not focused or the opportunity is so big that incumbents are going to be all over it and you won't be able to compete. Below $2 billion, now all of a sudden it's kind of too small. And even if you're successful, it's very unlikely that there will be enough value capture to build a venture scale business, right? So
mhm,
that's kind of the range that you're looking for. Now, that's like the early indicator. The next piece that you're looking at is, what were the assumptions that led you to that number between 2 and 10? And are those assumptions reasonable? Right? So, example might be, you say, okay, I'm going to sell, golf clubs, and the market's 10 billion, market's $20 billion. And you say, oh, well, that TAM's too big. Like there's going to be so much competition. So then you might say, well, we're only selling to left-handed golfers. Well, now
mhm,
all of a sudden the TAM's $6 billion. And like you're in that range. The question becomes then, as an investor, was that a reasonable assumption? Like, do I think that they will have more competitive advantage selling to only left-handed golfers than to all golfers? Is that something that they can support or protect, and so on? And so it's less about like the number that you come to and more about like, what do I need to believe this number is true? Because you can manipulate the assumptions all over the place in order to create the TAM you want. One of the things I see really commonly is what I would call like value prop stacking, which is like your business needs to do like 70 things in order to have a decent TAM. It's like, we are a platform for social networks, for NFTs, and advertising, for partnerships to create, a longevity in elderly people who are interested in AI generated content. And when you look at that, you're like, okay, you basically bolted together 9 businesses to get to a TAM of $1.5 billion. That's not going to be a strong business, right? Each of those endeavors that you need to take on is its own risk vector. It's its own challenge. It needs its own type of team, own type of technology stack. And so those types of companies is a huge red flag. Like when you see a company doing that in the very early stages. As they get to be really large, now all of a sudden they've consumed all the value in a given vertical and they have to move. It's like Amazon, right? They consumed all the value in e-com, or in books. So they went to DVDs, consumed all that. So they went to toys, consumed all that. So they went to, AWS. Now they're into AI and healthcare, right? Like that's normal for, $2 trillion business. When you've got 3 people and, $250,000 of funding and you're trying to do 7 different really hard things in order to have a decent sized TAM, usually means the things that you're doing are not valuable enough.
when you are evaluating the valuation, so like I really like what you said about TAM, and like when you're evaluating a company based on their valuation, how do you kind of evaluate a business besides like looking at their revenue run rate, or like what kind of multiple do they have to achieve, or like at what kind of growth rate, like for example, let's say like a consumer business, like how a consumer tech business, so how would you kind of evaluate these benchmarks, or do you think of like their, if the company's like logic makes sense first, like what you just said about like at the best, like this is like how they
Yeah,
could
sure.
perform. Yeah.
Yeah. So, and again, our firm may be a little bit like different. I I probably don't know enough to speak for others, but I will say in our case, we're less sensitive to the valuation just as a rote number. The things that we look at are one, is the founder or the founding team being intellectually honest about where the business is and how much it's worth? Because in many ways, like it sets the foundation for this relationship that you're going to build with them as an investor. Right? Like when I write a check into a company, I am basically committing to you for the rest of your life. Like the reality is, like this company may or may not be financially successful. If it is, you'll probably do another one. I'll probably be a part of that journey. If it isn't, you'll probably do another one. I will probably be a part of that journey. Right. And so you're looking for these indicators of like an intellectual honesty and sort of foundation of a relationship here. And if a founder is just like fully optimized on like how much money can I get out of you in this one transaction, they're probably not going to be a good partner as it relates to building for this business or for their career and for in my career as well. So I think that's part of the indicator of like valuation. I see a lot of companies come out now where like the founders are trying to optimize for this single transaction. And it's like, this is one of a dozen transactions you're going to do over the next 10 or 15 years. Like optimize for the long term, optimize for the journey, optimize for the outcome, as opposed to just like, can I get an extra 20 bips by changing the valuation on this business, 2 days before closing, right? Which has happened before. Like I've had founders do that. And it's like, I think it's suboptimal, right? Like you're optimizing for the wrong thing. The other piece that I think we pay attention to is what level of commitment and ownership can we impart like on the company. In our case, like, there are 4 general partners at Lobby Capital, including myself, and we only do a select number of deals each year. And I think the same is true for Benchmark and for like many of other firms of sort of similar size. What that means is like we're not just investing in you, we're backing you. And the big asset for us is time. Is like you get our time, you get our energy, you get our brains, you get our network, many of which took 20 or 30 or 40 years to build. And so that model doesn't necessarily support us buying 3% of a company or 5% or 10%. When we come into a business, like we are trying to be your partner. And that means owning partner level equity. And I think that's in many ways what a founder wants. Like you want someone who's not just riding on your back, and saying, hey, call me when the IPO happens, but instead is like actually picking up a shovel and helping you dig. So making sure that the valuation supports us being able to buy enough of the company that it justifies the time that will invariably come with that partnership. So those are like the ways that we look at valuation. We really don't fight over like, 25 million or 20 million or, whatever it is. As long as founders being intellectually honest lets us sort of create enough ownership that it justifies the time and the opportunity cost of where that capital could have gone otherwise.
I wonder when you're thinking about portfolio construction, let's say if you like save 40% for like follow on and like, each partner invests in like 5 deals per year or something like roughly like that. Like, I wonder as an investor, how do you spend your time on hunting down the 5 deals that year? Like, since that will be like, I don't know, 2-3 months, you will have to invest in a deal. And like, do you invest in like each deal you're like evaluating, will this return my whole fund? Or like, would you just like, oh, okay, so this company shows like strong growth metrics, but they're not as like super, SpaceX type of deal, like that will, I don't know, like just like have a really giant up and down? Or would you focus on like, crazy high return, high reward, but high risk company, how do you kind of spend your time on hunting down these like 5 companies that kind of make sense for you to return the whole fund?
Yeah, sure. So, I mean, look, I think the dirty secret in venture is like no one really knows. It's amazing, like how fast, like how often the companies sort of yo-yo, where it's like they're doing really well and then they're not, and some other company that wasn't doing well is like all of a sudden, the sort of running the leaderboards. And so, I do think you have to have some humility about never being too bullish on any given company and never being too bearish on any given company. I've seen it go both ways, like in a very short period of time. I think going back to what we were talking about earlier around like knowledge arbitrage, a lot of the time is spent on understanding like where is that baseline of knowledge creation happening in a given vertical, and then looking at companies in that space through that lens of like how far or how much are they deflecting from that baseline of knowledge. Like to what extent are their insights unique and novel and growing quickly? To what extent are they creating knowledge faster than everyone else in that space? Yes, there are many, many hundreds of companies that are building like customer support chatbots powered by AI, right? But what is this company doing that's maybe diverging from what everybody else knows? And maybe that what they know is like, it turns out that, if the bots are trained for like emotional crisis, then they actually do way better than everybody else, right? That's an interesting insight, right? And if they've created that insight and they're continuing to build on it and iterate on it, like that's an interesting opportunity, right? That you may want to, partner with them to try and accelerate that even further and sort of pair that with capital. And so a lot of your time is spent on like getting smart about where is that baseline and understanding the companies who are players in that space and how, again, far that they're deflecting from that baseline. There's a tremendous amount of like imparting goodwill, at least in our firm. Like we host the Lobby Enterprise, Lobby Elevate, Lobby Consumer. We do a female founders, summit, and all of these are about like putting energy into the community such that what comes back, what's reflected back, is superior companies, superior founders that are inbound. In many cases, they're coming to you because they're saying, you created value for us even when there wasn't anything to capture. We'd love for you to continue creating value for us as a partner or as an investor. And so you actually spend a lot of time just trying to be helpful. I think founders sometimes think that it's they're being catfished or something. Like sometimes I'll reach out to them, like, hey, what you're working on is really cool. Let me know if I can help. And it's not always capital. In fact, most of the time it's not capital. It's like, hey, let me introduce you to these like 3 potential customers. Like surprise, it makes me look good too, right? When I bring a great founder like over to some company, yeah, we might not invest in it. It might be early for us, or it might be late for us, but you created some value that in some way is going to help move the ecosystem and probably come back to you in a good way. So to your question, like, yeah, you might only do 2 or 3 deals a year. The rest of the time you spend just doing good things for founders. And if you do enough of that, like good things will happen. And I think in many ways, that's the job description. It's not like being opportunistic about jumping on a founder's back and like riding them to IPO. Like that's not the job description, although some people might think that. So anyways, that's kind of my philosophy on it.
I want to say hi to the audience. Hi, Brad. Anyway, so let's say if we are talking about lead or follow, like, I guess, what's your thought on like, if you are like a younger investor who is like, portfolio building in their portfolio building era, should they lead or follow? And like, how does that place into the portfolio construction? Like in terms of like, staying consistent with the strategy of your fund?
Yeah, like I think part of that, especially in today's climate, depends on how much capital you've raised. Especially looking AI is a great example where like there are deals that we don't get into at all because our thesis is around leading. And sometimes um, sometimes the valuations come in so high that the amount of capital you need to deploy in order to have, again, the ownership that makes sense for your portfolio, like that portfolio math doesn't make sense. So I think for every fund manager, you have to be paying attention to like, what are you particularly good at and well suited for, both in terms of the capital that you have, the skills and value that you can bring to the table, and so on. So if you're a smaller fund, you're probably not leading, or you may lead, but like at the pre-seed level, right? Or you may lead at the seed level, something along those lines. So I think there's a couple different variables that you have to be paying attention to, but it ultimately comes down to like, what are you good at and well positioned for as a fund, and then leaning into that advantage.
If you are like, since like leading deal is like your, like, your fund strategy, I wonder, how do you look at, as you mentioned, like the AI hype cycle, like, if we're not looking at AI right now, like what are things that you feel like are kind of undervalued?
Ooh, good question. I mean, I don't think that AI is being hyped. I think that the attributes of AI, like in some of them, may be sort of misappraised. Meaning, so the example I think of is like the original Fast and Furious. I don't know if you ever saw that movie, right? Like, but I'll just give you a quick synopsis. It starts off with this scene where Paul Walker goes and gets this like Mitsubishi Eclipse. It's like this beautiful car. It's got like paint and all this stuff, and he goes and gets nitrogen and he appends it to the engine. And then goes and races like Vin Diesel's character and so on, but ends up blowing the engine manifold in the process. And why was that? Because like the engine itself was fundamentally not strong enough to support what the nitrogen was trying to do, right? What the NOS was trying to do to the engine. If you contrast that to like the end of the movie, he goes and finds this junkyard Supra that has this, really ugly looking engine, but that was very like strong and capable, and then applies nitrous to that, and it becomes this exceptional car that like beats Ferraris and Lambos and like all that kind of stuff. And AI is like very similar, where it's like if the fundamental engine in the business sucks, it doesn't matter if you apply AI to it. You just end up doing a whole bunch of the same bad thing that's not generating returns for you to begin with. So in many ways, like the thing you're looking for is a business that's fundamentally strong and sound, even though it might not be pretty. And then the ability to apply AI to it and create an inflection point as a result. Those types of businesses I think are interesting. And I think the valuation sort of makes sense relative to revenue and growth and so on. But when someone comes in and says like, oh, we're just an AI business for the sake of being AI and our valuation is X, a lot of times those numbers don't make any sense, and, for us, like we're just really disciplined investors in the venture sort of domain. We won't do those deals. And maybe there's some things that we'll miss that will turn out to be, big companies and so on. But again, if you're optimizing for the long term and you're optimizing for a long career in venture, then exercising discipline, I think, ultimately generates a better outcome over that career than sort of trying to optimize on any one deal that may or may not turn out to be the next big thing.
Mm. I wonder, when you are evaluating the AI companies, how do you kind of um like, I guess, like evaluate if a AI company is going to be successful? Since like I feel like most company I've seen are like um either like they have revenue, but they're in like a very fragmented space, as like, I don't know, AI wrappers or like GPT wrappers or whatever the
Yeah.
term people are using. Or like they are, building foundational models, which will cost like $1,000 billion to like build. I wonder, how do you spend your time in the AI space to pick the hidden gems?
Yeah. I mean, even now, right? Like, so when we talk about, some of the potential companies that you just sort of mentioned, like LLMs, or like they're doing, embeddings, or they're doing training and so on. The reason why some of those are comical, like where we'll kind of chuckle at it because you've seen so many of them, is because what you're realizing in your head is like they haven't really diverged from the common knowledge in that given space. It's like, oh, you're doing an LLM, so is everyone else. What is your LLM offering that theirs doesn't? And the minute that you find one that is offering something that diverges, well, now all of a sudden that's really interesting, right? And so you have to kind of pass through this stage of cynicism where like you've seen a bunch of something and then recognize when you've seen something that's now diverging from all of what you just saw. And I think sometimes people, sort of maybe more inexperienced investors, they get stuck in the stage of cynicism and they're just like, oh, I've seen a million of these, this will never work. And like, that's a big mistake. Like, you have to push through that resistance, through that friction to the other side. And then you start to see sort of the pack thin out. And it becomes really clear like who the leaders are. And then you're trying to go and, partner and create value for them. And that's kind of the name of the game. So to your question about AI, I don't think it's any different than any other vertical. I think you've got to lean into understand again where that baseline is of the art and where it is heading, how fast people are generating knowledge in general, and then push all the way through that to see the people who are actually now creating knowledge at a very different rate than everyone around them.
I have one last real question and maybe like a 1 minute fire round if you have time. So, okay, so let's say if a company come to you and then they're saying they're growing really fast and like they have generated revenue, looks attractive. However, they have an industry competitor that has raised over 100 million. How do you see this kind of business? Like they're like, for example, let's say their counterpoint is like, we're growing really fast. Like we're growing as like, we like have reached this point when like this other company have done this in forever. And then they're like only generating this amount of money, but they have reached this amount of money. How do you kind of evaluate these kind of scenario? Like, do you believe in like, I guess like what are the benchmark you will be using to see if this business actually makes sense, or like maybe they just haven't found out like this other thing that which is like making their competitor are all kind of quote unquote losing?
Yeah, like that doesn't scare me. Like, I think in many ways competition is validation. It goes back to the point I was making earlier. There's 8 billion people in the world. If you're doing something that no one else is doing, you're like either impossibly smart or incredibly stupid, right? Like, so statistically. So the fact that other people are doing it is great. Like, I love it. What I am looking at then is how pure and unique is your insight about what is going on in the market, how value will be created relative to the competitor. And it's not a function of cash. And I think this is part of the challenge. Like, founders think that the problems in their business are all money problems. If I just get more money, then it will solve everything. A lot of these things are not money problems. Talking to customers, not a money problem. Going out and selling, not a money problem. Like, you just have to put on a bag and go and talk to them or go and sell. And so what you'll find is you'll have a company like, maybe a Perplexity or even like an OpenAI, where their insight is unique, that chat should be the interface and this is how we should deploy it. And they're going head to head against Google, right? Like, you would think that if it just came down to capital, if it just came down to size, the little ones would never win. So inherently, you can prove, or empirically, you can prove that that's not the case. It's not just a function of raising cash. There's a bunch of companies that have raised a bunch of money and burned it all up and didn't have anything to show for it, right? And so what it really comes down to is, have you done the work? Have you done the hustle to generate a truly unique insight and continue to compound and iterate and build on that insight such that it creates a sustainable advantage for you? And if you do those things, then capital is not going to save your competitors, right? You're going to steamroll them because you're going to create value all day long. And you're going to be able to turn that value into dollars, and that's going to continue to propel your business forward.
Okay, so we have a last 1 minute fire round for you.
Yeah, sure. Let's do it.
What's your favorite book?
Oh gosh, my favorite book, Demand Side Sales by Bob Moestis.
Oh my God. I've been like binging all the sales books. I feel like I definitely
Yeah, I
need to
love
have
that.
this one. So what's your content diet look like? So beside books, what else do you consume in your
I
specific sector?
consume a ton of podcasts, probably way more than I should. Like the news, acquired with
Mhm.
um, David Rosenthal and Ben Gilbert. Yeah, I love all of those like podcasts.
Uh, who would you invite to your dinner party?
Oh, dinner party. I have a friend, Mark Manera, who is like leading the startups program at OpenAI, and he's like one of my favorite people. Just like
Mhm.
generally amazing human being, and working on interesting stuff. And then my like former co-founder Ashutosh Joshi, who does the same thing but for NVIDIA. Yeah, I like being around them, and they're both wicked smart. So those would be my two.
Uh, who made the biggest impact in your career?
Sam Yagan,
Yeah.
founder
Oh,
of SparkNotes, and
yeah. He was on my podcast.
yeah.
Everyone should check out his episode as well.
When I
Uh,
met Sam, I was like living on a farm, and he was like, "Hey kid, come on, let me show you how to build a business and like what to do," and like literally changed my life.
Amazing. Where can we find you outside of work?
You can find me in the office, sometimes at the gym over at Stanford. I teach there a couple days a week, and online, my handle is Pithy Prof.
What does
PITHYPR.
that mean? What is
It's
pithy?
this nickname I got in class because I would say these snarky things like, competition is validation,
Oh my god.
and so I got, yeah, this moniker that things I would say were pithy.
Anyway, amazing. Thank you so much, Colin, for coming on the show today.
Yeah, thanks for having me. Looking forward to seeing you soon.
Okay, let me quickly end.